Hello, I'm Jon Najarian, and thank you for joining Trader Talk. Today I have Amelia Bourdeau, founder and CEO of Market Compass LLC, as well as Kathy Lien, managing partner of BK Asset Management, joining me to discuss Forex and metals. What do you think major catalysts, the way they've impacted the market this year, will they continue to have that same sort of impact next year?
So there's a couple of themes that happened in 2019. Basically, the cycle of global easing, along with the decline in volatility for our market specifically, and then on top of that, policy uncertainty. As we look forward to 2020, I'm sorry to say a lot of those things will still remain big problems, and that we're still going to have an environment where there's political uncertainty. It's just shifting from Europe to the U.S. We're going to be moving into a phase where, yes, we may not have aggressive global easing, but monetary policy is going to remain very accommodative. Rates will remain low. Maybe a few central banks will ease further, but that's still going to be here to stay. And I think in addition to that, you've got just a cycle of volatility that could increase a little bit, but we're not going back to the heydays that we had before, which is good and bad depending on how you look at it.
And Amelia, as far as that volatility that Kathy was talking about, when you have in 2018 the Fed moving against every other central bank, and all of a sudden the reaction, the flip to that, when all of a sudden Jerome Powell and the Fed began cutting rates, do you think that played into the volatility just getting crushed like it did in FX?
It's one factor.
Okay.
I think right now what's going on, and will continue into 2020, certainly, is we have two huge themes that are driving, in part, G10 FX markets. And one is what you referenced, Brexit, and the other is the U.S.-China trade war, which has been flip-flopping U.S. equity markets all year, from a risk-off to a risk-on environment. I know U.S. equities are at a new high, but it was a painful journey at times to get there. It wasn't a smooth ride. And so what's been happening now, and why I think vol has been so low, is because the market is a bit complacent about these two huge themes. So Brexit, a hard Brexit, has been taken off the table, and the U.S.-China trade war seems like that phase one is going to get signed, but in reality, neither one has been completely solved.
I want to throw out metals to you, because when we talked about doing this for the CME, we said, okay, FX and metals. Gold, one of the main metals that when we talk about metals that always comes up, is up almost 15% this year. Let's say, give or take 15%. And similarly, there's been folks that are trading cryptocurrencies and so forth, other things that are, the assets gather their value by their scarcity. So to some extent, some of those cryptocurrencies fall into that category, not all of them. But as far as metals, do you have an outlook going into 2020 about precious metals in particular?
Yes, I think that a possible example is that gold could continue to rise. One of the main reasons why gold has appreciated so much this year is because of all of the political uncertainty across the globe. And I think that that's going to be something everyone has to grapple with, or continue to grapple with, in 2020. Gold tends to perform well when we have an environment of political uncertainty, low inflation, as well as low yields. And that's the exact same environment we're going to be walking into in the 2020. Jerome Powell made it very clear at his last monetary policy meeting of 2019 that interest rates won't be rising until there's a significant uptick in inflation. And he even suggested that they could take some other action, which makes it very clear that policy is going to be accommodative, and the Federal Reserve won't be moving the needle in interest rates at all. And that type of environment, investors tend to seek yield, seek safety, and gold tends to perform very, very well.
Amelia, do you have any trade examples?
As I mentioned, I do like yen as my preferred safe haven currency. I like to trade yen just personally. So throughout 2019, you've seen, if you look at a chart of S&P futures and you look at 6J, yen dollar futures, you see that in times, especially in times of a down market in U.S. equities, yen is a safe haven. Yen also appreciates during that time. It's a safe haven currency. And so any risk off movements throughout markets, I continue to like to be long yen. So just as an example, if we look at the 6J, say we take a near-term contract, that's the dollar yen future. We're trading in a range right now, spot 00928 to 00915. And we're ranging there, okay? So if we do get some sort of risk-off move, for instance, the phase one trade deal doesn't get signed, there's a bit of a hiccup, or new tariffs are instituted by the U.S. administration. And by the way, it doesn't have to be the U.S. administration. What about China? China could implement tariffs on the United States as well. So some negative headline on the trade war front. Then immediately I prefer to be long the yen against the dollar. I prefer to be long that 6J future. And I like to manage in the nearer term contract because I feel like the movement takes place soon, near term after the headline, not so much long term.
Mm-hmm. And Kathy, obviously the headlines, I mean, it's almost like a CSI episode where you're saying this is ripped out of the headlines. Everything with FX and metals involves politics and what's going on globally. So what would your trade example be?
Absolutely. I've got my eye on the euro. The euro is one of the most actively traded instruments, usually the best reflection of the market's appetite. But I think, we've got a lot going on in the euro. First of all, for the most part, the worst is over, in my opinion. I think that, Germany avoided recession by, the skin of their teeth, and that was a very big story because that basically gave the German government an excuse not to increase fiscal stimulus despite the pressure from the European Central Bank. We also have a situation where, politics are necessarily going to make things worse. There's elections in Spain and Portugal this coming year, and most likely it's going to be status quo. You're not going to see any major disruptions. The migration crisis seems to have peaked. We didn't have, major victories for populism this past year, but that does not mean that the euro is out of the woods. They're still deep in the woods. Part of the reason is because growth is very, very slow. Inflation is very, very low, and the German government really wants to avoid increasing fiscal stimulus until it's absolutely necessary. So unlike the yen trade where Amelia would be focusing on the short-term contracts, I think that you look at either longer dated options or just euro futures straight out. And I think, there is definitely some potential downside. The levels that I'm looking at is 106, 105.
You wouldn't just be shorting the future, you'd be putting on puts or put spreads?
Either way.
Longer dated?
Yes, it would have to be longer dated, and or you can just use the futures contracts.
Gotcha.
And in addition to that, we talked about how 2020 is an election year. So election years historically have been terrible years for the euro. In 9 out of the last 11 years, the euro has actually declined in an election year by an average of 5%. So the odds are certainly not on its side in the coming year. And I think, from the perspective of, economic strains as well as political uncertainty and a central bank that's not going to really move the needle on monetary policy, there is certainly opportunities, I think, to the downside.
Amelia, you have another trade for us in the Aussie dollar. Please share it with us. Because
the U.S.-China trade war, I believe, will be ongoing for most of 2020. Another way or another example to look at the U.S.-China trade war is by looking at the Australian dollar. So China is Australia's largest trading partner, and negative news for China on the trade front negatively impacts Australia as well. And Australia has going on a bit of a domestic demand slowdown right now. The central bank has already cut rates. They're on hold for now, but we do have a big rate meeting coming up for Reserve Bank of Australia February 4th. So I just wanted to look at the 6A, the nearer term contracts once again for the Aussie dollar. And right now we're trading, in a range, 67.50, 69.25 area. And if we do have some negative headlines regarding the U.S.-China trade war especially, or if China decides to depreciate further their currency, the renminbi, that depreciation of renminbi, should it come, really negatively impacts the Australian dollar. So it's almost, I take it as a leading indicator almost. If there's negative trade war headlines, there's a depreciation in renminbi, I always go to Australian dollar and see how it's behaving. And so I do like Aussie lower on any negative outlook for the U.S.-China trade war. And I think 67, the figure to the downside, is a really key level. So I'm looking for it to move there. Should it break, the next level is 66, the figure, one big figure underneath it. And I'm just holding on, maybe longer term, and with very, very negative news, we would need to break that level. But there's not significant support underneath that. And so the nearer term support underneath that is all the way down at like 61.70, which is a 2008 low. So I just wanted to highlight that. It's something to kind of watch for most of the year next year to see if we can move down towards those levels and to be aware of.
Beautiful. Thank you very much. Folks, I want to thank both Amelia Bourdeau and Kathy Lien for joining me here today, providing their expertise on FX and metals. Amelia with trades on the yen as well as the Aussie dollar, and Kathy with a longer dated trade on the euro dollar. And folks, thank you for watching.